Okay. Hello, everyone. We are Team 5, and today we're presenting on Case 4, Cendant Corporation. I'm Olympia.
I'm Joan.
I'm Josh.
I'm Wayne.
So today we're going to be presenting on Cendant Corporation. Some overview of the company. It was created through the merger of HFS Incorporated and CompuCard, CUC, in 1997. They provide a membership-based and internet-related services and control some franchise brand names that you might know, like Century 21 and Holiday Inn. The merger brought together two companies with different ethical climates and cultures. So how this happened was that CUC top management was, in this case, the unethical party. They used earning management techniques to manipulate the financials and meet the analyst expectations every time. The records show that they could have done this as early as 1985 until the discovery of the fraud in 1998. After the merger in 1997, CUC continued to carry its activities through the use of the same techniques, but now they carried out through top management that continue on to Cendant. In 1998, HF's accounting team is sent to aid in the financial statement preparation, and this is how the fraud was finally discovered. Some of the techniques that were used were revenue recognition management, poor management and proper use of liabilities account, unsupporting accounting entries, and misuse of reserves. Next, I'm going to pass it on to Joan that she will discuss the first discussion question for the case.
Throughout the course of this case, one thing that kept coming up was income smoothing, and we deemed that it was not an ethical practice. Income smoothing involves manipulating and adjusting earnings and revenues to help illustrate that the company is performing better than it actually is. In this case, Cendant manipulated the reserve accounts to boost their operating income. The way they did this is they overstated restructuring costs and used the excess reserves to offset their normal operating costs. And the primary reason to smooth net income is to showcase that a company is operating well and steadily. And we also found that there are no circumstances where the practice of smoothing net income would ever be ethical. Since it involves manipulating and adjusting accounts, it's just not ethical. And it also violates principles of full disclosure and transparency, and the duty to the shareholders and public is broken. Cendant was motivated to meet the expectations of Wall Street analysts, and the top management also received bonuses and stock gains from their income smoothing practices. By engaging in income smoothing, Cendant management failed to uphold their duties and responsibilities to the shareholders and the general public, which illustrates what happens when a company puts itself before their shareholders and the public. Over the course of the scheme, it resulted in $500 million being added to pre-tax income over the 3 fiscal years. Next, I'll pass it on to Wayne to discuss the next question.
So Donald R. Cressy, a criminologist, is first credited with coming up with the concept of fragile triangle. The fragile triangle is a framework or model used to explain the reason behind the decision to commit fraud. So there are usually 3 components or conditions generally presented when fraud occurs. First, on top of the triangle, management or other employees have an incentive or sometimes under pressure, which provides motivation for the fraud. Second, on the lower left, circumstances exist that provide an opportunity for fraud to be perpetuated. Example including the absence or ineffective of internal control, or management able to override internal control. Third, those involved are able to rationalize committing a fraud act. So each of these 3 components interact and link with each other. For example, an individual may have a high degree of financial pressure to commit fraud, but it's less likely if there's no opportunity or risk being detected. It's very high. Meanwhile, a happy, sufficiently compensated employee is not likely to commit fraud, even there are opportunities to present itself. Similarly, a person who has the opportunity also has the incentive to commit fraud. But if the individual has a strong moral conduct and cannot rationalize of their behavior, they also are they're also less likely to commit a fraud. However, when these three conditions, pressure, opportunity, and the rationalization converge, it forms a very high-risk environment that ripe for fraudulent actions. And that certainly demonstrated in the case of Cendant. So first of all, let's take a look at the incentive. The incentive to commit fraud typically is a self-serving one. In the case of CUC, because CUC is a public trade company, its stock price is largely driven and determined by its financial performance and profitabilities. CUC senior management implement a scheme designed to ensure that CUC always met the financial results anticipated by Wall Street analysts. One way of doing that is by manipulating timing of the write-off and by improperly determining the nature of charge occurred. The CUC are able to write off to inflate the operating income. Moreover, the incentive is also for personal gain, where top management profit from their fraudulent action by selling CUC stock at inflated price. CUC also face pressure from Wall Street analysts to meet the quarterly and the financial results. In addition, the employees will also face pressure from top management as middle and lower level personnel were instructed to make fraudulent entries. Next, we're going to go over the opportunity to commit fraud. Opportunity will also present it that fraud can be perpetuated. Poor and unethical tone from the CUC senior management allow and result into the fraudulent action and to influence the company culture. From the ethical dissonance model, there's a low organization ethics as evident that top-level executive committing and instruct unethical behavior, and the low individual ethics where middle and lower personnel did not challenge the fraudulent entry they were instructed to do so. The low-low situation create an unethical environment that ripe for fraudulent action. There is also a lack of internal control in place within the company, and the individual from top management can easily withhold information from the auditor, manipulating accounting treatment entry for the purpose of covering the fraud as well as for personal gain. Lastly, deficiency or inadequacy from the auditor also creates opportunity and contribute to the fraudulent action. For example, the auditor overly rely on the management representation regarding the appropriateness of the reserve, perform little self-testing of their own, despite red flag and evidence that reserve were established and utilized improperly. Lastly, CUC management tried to rationalize the fraud by implementing income smoothing scheme in order to meet the investor and analyst expectation. However, as the scheme progressed over the course of several years, larger and larger ENA adjustments were required to cover the fraud and show smooth income over time. Another justification that company use is that increased earning will keep the stock price high, therefore maintain a good financial position for the company. Next, Josh is going to go over the question 3.
In this case, professional judgment does not play the role it should because auditors never come into question regarding the information provided by CUC and Cendant. For example, there were many red flags that should have prompted for their investigation, such as the collectability on rejected memberships, fraudulent entries, lack of internal controls, and income smoothing. They also lacked the supporting documentation for their accounting practices, but never came into question from EY to produce their paperwork for their transactions. The auditors did use professional judgment when presented the audited case, but did not detect this fraud due to the lack of questioning regarding source documents. The auditors did not meet their ethical obligations according to ACCTG code because of their lack of due care and responsibility. Since there's a sense of obligation of ethical care, the auditors should have required the source documents for the suspicious transactions going on with CUC and Cendant. The auditors also failed to follow through with their responsibility of verifying the financial transactions of their sources. And the auditing standards were not met because of the failure to verify the accuracy of the CUC and Cendant financials, allowing for their fraud to go undetected through their own responsibilities that should have been brought up through professional judgment. And with the lack of the internal controls and fraudulent entries, those should have been red flags that should have been noticed by the EY auditors, because not only was something like income smoothing conspicuous, it was also resulting in payouts to their executives. And I will now pass it on to Olympia to discuss questions 4 and 5.
So how is the trust broken between auditors and clients? We know that it is a very special link between clients and auditors. There has to be trust. So in this case, the client withheld information from auditors and compromising the integrity of the audit itself. As Josh mentioned, the audit did not meet any of the standards. The client continually deviated from GAAP when preparing financial statements. And an auditor must be able to trust the client is abiding by the laws and regulations applicable to the state. In this case, CUC was continuously doing transactions that were not in accordance to GAAP, and EY was just not able to verify because they were withholding documentation and they were manipulating such documentation when provided to the auditors. A client provided incorrect schedules at some point in documents, followed by even more documents that were supposed to be corrections, but still were not aligned with the first version. This type of activities done by a client just causes a great amount of mistrust in any document provided by the client and can cause reasonable doubt in the trustworthiness of the financials prepared by the client. How Cendant's corporate governance felt in this case. First of all, the board of directors was not dependent, and it was voted by the shareholders. It created the wrong tone at the top. A lot of the CUC top managements went on to Cendant to be top, essentially have either the same or higher role in the company. As we've seen this in the case, it was CUC top management that actually led the fraud, which caused a lot of internal control issues. And then they also allowed management to continue the fraud for many years because they were not, like, those controls were just not set in place correctly. And they were able to make post-close entries that were that would mislead the public to believe that the company was more profitable than it actually was. There was also a lack of transparency across the company and to all shareholders, and performance bonus was tied to stock price, which only fomented the pressure to meet the Wall Street expectations. So the last question relates to, do we think that auditors should be expected to discover fraud, even if the company goes to great extents like Cendant did? In our opinion, auditors should be expected to discover such fraud, while only 4% of cases that have been discovered were through external auditors. They do have the social and ethical responsibility to the public to conduct an audit engagement to the best of their abilities. There were multiple red flags, as Josh mentioned, which should have been either a right nudge in the right direction to either alert the authorities or just get themselves away from that engagement. While a client can go to great lengths to avoid detection, it should cause even further suspicion when a client does not want to give out documentation and is just really sketchy and hiding any type of file that could lead to the discovery of any fraud. And more than once, EY in this instance should have applied enough skepticism, such as when they were given the wrong documentation and when the second version of that document was given to them again. It was nothing like the first version. Should have caused enough doubt to remove themselves from that engagement. And then if they were reviewing this financial statements prepared by CUC, they could have seen that they were not in accordance to GAAP, and still they provided their own qualified opinions. So in conclusion, CUC ethical practices is an example of how the wrong tone at the top and poor corporate governance can lead to fraud. Some of these consequences that were brought up by the case were that the individuals involved were charged and suffered the different type of consequences depending on their level of involvement. A lot of them, it was cash settlement for disgorgement. Some of them were not able to serve as directors or were not able to provide financial advice for at least 5 years. For Cendant, it ended up being in a 3.2 billion cash settlement to stockholders. EY was one of the largest settlements for auditors in history, for 335 million in cash settlement for their involvement in their fraud. As I mentioned before, they actually provided unqualified opinions on their financials when they really did know that they were not in accordance to GAAP. And Cendant had to restructure their organization and place internal controls that would be effective in detecting fraud. And lastly, which is probably the most important, the public trust was broken between the company and shareholders. Until this day, the president of HFS, which is one of the companies that merged, is still trying to repair that trust with the public following that fraud, and it just places an importance on how ethical practices should always be part of the accounting profession. Here are our sources. We used Econ Crisis and the book by McGraw-Hill for our sources. Thank you very much. We look forward to your questions.